Is retail coming back to crypto? That's the big question right now. And today we're going to break it all down because there's a lot happening under the surface that I think you guys really need to pay attention to. There's been a ton of news over the last few days, some of it pretty quiet, some of it flying completely under the radar, and then there's a couple things toward the end that honestly tie all of this together in a really interesting way. So make sure you stick around for that. Before we jump in, I do want to quickly thank our sponsor. Today's video is brought to you by a self-custody wallet that we personally like because, as you guys know, self-custody is becoming more important than ever in this market. If you're still leaving everything on centralized platforms, it's probably time to rethink that. You can check the link in the description if you want to learn more. With that said, let's get into it because there's a lot going on right now. I want to start with the broader market context, because I think this is where a lot of people are getting confused. If you look at previous Bitcoin cycles, the way tops and bottoms formed was relatively clean. You had clear retail euphoria, clear blow-off tops, and very obvious sentiment shifts. This cycle feels different. And that's not just a feeling, there's data to support it. Bitcoin is still significantly off its highs, and depending on where you measure from, we're talking about a drawdown that would have historically marked the end of a cycle. But the behavior just isn't matching that narrative. One thing that's really interesting is that a lot of the indicators people relied on in past cycles just haven't been as reliable this time around. And I've been saying this for a while. Trying to overlay old models on a new market structure doesn't always work, especially when you factor in institutional involvement, ETFs, macro conditions, and regulatory shifts. This market is being influenced by forces that simply didn't exist in 2017 or even 2021. So when people say, just watch the charts, I get it. But there's a lot more going on than just technicals right now. Another big piece of this puzzle is retail access, and this is where things start to get interesting. Over the last few years, retail participation has been relatively muted. Institutions stepped in, liquidity shifted, and a lot of everyday investors either got burned or got bored. But now we're starting to see signs that retail infrastructure is quietly being rebuilt. And one of the biggest players here is Robinhood. Robinhood, whether you like them or not, has always been a proxy for retail behavior. When retail is excited, Robinhood activity spikes. When retail pulls back, you see it immediately in their numbers. And now, they're making a pretty aggressive move by launching their own chain. This is live on testnet, and while it's early, this is not a small development. This is Robinhood positioning itself not just as a brokerage, but as an infrastructure layer. What's interesting is that they're not leading with meme coins or flashy launch pads. Instead, they're leaning heavily into tokenized assets, tokenized stocks, and real-world assets. That's a very deliberate choice. They're clearly trying to bridge traditional finance and crypto in a way that feels familiar to their user base. And when you think about it, it makes a lot of sense. Robinhood already has a massive distribution advantage. And if they can successfully abstract away the complexity, this could be a major on-ramp for the next wave of retail. Now, one thing Robinhood has always done well is gamification. Love it or hate it, they understand how to design products that keep users engaged. Combine that with a new generation of investors who are comfortable with apps, digital assets, and alternative financial instruments, and you start to see why this matters. But execution is everything. And this is where I remain cautiously optimistic. If you look at Robinhood's track record, they don't exactly move fast. Credit cards rolled out slowly. Banking features took longer than expected. A lot of things were promised well before they were delivered. So while the vision is compelling, I want to see this actually working at scale before I make a strong call on it. That said, the fact that developers can build permissionlessly on the chain while Robinhood selectively integrates and elevates certain applications, creates an interesting dynamic. Liquidity is another key factor here, and this is something that doesn't get talked about enough. Tokenized assets live and die by liquidity. Without it, everything breaks down. Pricing becomes inefficient, collateralization becomes risky, and users lose confidence. Robinhood believes they can solve this by routing orders across multiple venues to find the best price, similar to what they already do in traditional markets. If they can pull this off in crypto, especially for tokenized stocks, that's a big deal. The regulatory angle also plays a huge role in all of this. Clarity, or the lack thereof, has been one of the biggest bottlenecks for crypto adoption in the US. We've seen fragmented rules, state-by-state differences, and a lot of uncertainty that ultimately hurts the end user. There's growing optimism that we're moving toward a clearer framework. And if that happens, platforms like Robinhood could move much faster. What's interesting is that while Robinhood is pushing forward, Coinbase has taken a slightly different path. Coinbase tried to lean into the social and creator side with their app, and frankly, it just didn't really work. The social layer never gained meaningful traction, and now we're seeing creator rewards being sunset. That doesn't mean Coinbase is failing, but it does suggest that retail engagement looks different than it did in the last cycle. At the same time, we're seeing pockets of massive activity on-chain. There are projects generating significant revenue, sometimes in a single day, and that tells you that demand is there. It's just not evenly distributed. Retail isn't flooding into everything at once the way it did before. It's being more selective, more narrative-driven. Another area to watch is payments and micropayments, especially as they relate to AI. We're starting to see experiments around AI agents transacting, coordinating, and interacting with financial systems. This might sound niche right now, but remember, a lot of technologies start with a very small group of users before they explode into the mainstream. Social media was like that. Smartphones were like that. Even crypto itself was like that. Asia is also a huge part of this story. While the US continues to move slowly, regions like Hong Kong are pushing forward aggressively. Stablecoin licensing, tokenized assets, and regulatory frameworks are being rolled out in a way that's very intentional. This opens up massive markets across the Pacific Rim, and historically, retail adoption in Asia has been incredibly strong. If retail is coming back, there's a very good chance it starts there. We're also seeing interesting developments on chains like Solana, especially around tokenized commodities like gold. The idea of being able to mint, trade, and even redeem tokenized gold across multiple ecosystems is powerful. It blends trust, liquidity, and accessibility in a way that traditional systems struggle to match. And again, this is the kind of thing that appeals to retail when packaged correctly. When you zoom out, one of the biggest themes emerging is gamification. Not just in apps, but in marketing itself. Look at what's happening outside of crypto. Big brands are leaning into puzzles, challenges, and interactive experiences. This keeps users engaged far beyond a single moment. And when you combine that with financial incentives, you get something that's incredibly sticky. There's also renewed speculation around legacy brands and platforms making unexpected moves. Whenever you see companies with strong retail recognition hinting at major acquisitions or pivots, it gets attention. And attention is the lifeblood of retail markets. Whether all of these moves pan out is a different question, but the fact that they're happening at all is telling. So where does this leave us? Retail doesn't just come back because prices go up. Retail comes back when infrastructure improves, narratives align, and access becomes easy. We're starting to see those pieces come together, slowly, but steadily. It's not euphoric yet. People are still cautious. A lot of investors are still sitting in stables, waiting for lower prices, waiting for confirmation. And historically, that's usually when things start to get interesting. I'm not saying this is the bottom. I'm not saying we're about to go straight up. What I am saying is that there are enough signals right now to suggest that retail is paying attention again. Maybe not all at once. Maybe not in the way we're used to. But the groundwork is being laid. So I'm curious where you guys are at. Are you slowly dollar cost averaging back in? Are you sitting on the sidelines waiting for more clarity? Or are you already positioning for what you think the next wave looks like? Drop your thoughts in the comments. I read through them, and I think the discussion down there is just as valuable as the video itself. If you enjoyed this update, make sure to hit like, subscribe to OGJohnX.X if you haven't already, and join our free private group linked in the description. Things are starting to move, And this is one of those periods where paying attention really matters.